whilst he's been in office, Biden's kind of wielded the big stick, but Trump might prefer to use more of a carrot method and kind of incentivize Russia to make the decision themselves to get oil flowing again. But we'll just have to wait and see.
Hello, welcome to the second episode of Oil Insights in 2025. I'm your host, Mita Chaturvedi, and I'm joined today by Onyx research associates Mita Dowding and Vincent. Our usual host, Harry, is on travel this week. Before we start the show, please like and subscribe to our podcast. I invite you to also visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. At the time of this podcast, front-month Brent futures were trading at around $81.8 per barrel. On the geopolitical front, a complex ceasefire accord was finalized between Israel and Hamas yesterday, after mediation by Qatar, Egypt, and the United States, bringing hope for an end to a 15-month-long conflict that has devastated Gaza. While the war had no impact on oil supplies from the Middle East, rising volatility from related developments such as the Houthis attacking ships in the Red Sea and tensions between Israel and Iran impacted oil prices. However, hours after the ceasefire and hostage release deal was announced, Israel reportedly intensified strikes on Gaza ahead of the truce's start on Sunday, lending further uncertainty to the future of the conflict or the resultant risk premia in oil markets. In addition, oil prices have been particularly impacted by President Biden's parting gift to Trump, supplemental sanctions on Russia on Friday last week. In this episode, we will examine the progress in crude oil prices and the changes in positioning since these sanctions were announced. These sanctions will undoubtedly complicate Mr. Trump's endeavor to reach a rapid solution to the war in Ukraine. More importantly, they could have adverse consequences for Russian crude exports. The US stepped up the pressure on Russia by sanctioning two of its major oil companies, Gazprom Neft and Surgutneftegas, last Friday. Together, they produce around 2 million barrels per day and export over 900 kilobarrels per day across a variety of grades. Moreover, the US added some 180 vessels to its sanctioned list, most of which are vessels which carry crude oil. This latest move by the Biden administration surprised the market in its severity. These sanctions are more broad-based and severe than their previous counterparts. The aim is clear: to prevent Russian oil flows and constrain the country's revenues, something the administration has appeared hesitant to do until now. We have yet to see how much Russian crude oil exports will fall due to these sanctions and how much domestic production will be impacted. For one, Russia has options. New dark fleet vessels could be solicited to carry oil. Legitimate tankers could also be employed, even as freight costs get pressured up, just as long as the price of the crude does not exceed the $60 per barrel price cap. Russia could choose to discount its crude to offset these higher freight costs. Finally, there is the option of diverting more crude into domestic refining. In addition, India, a major buyer of Russian crude, does not appear intent on ceasing their imports of Russian crude. The sanctions have led to strong buying interest in alternative grades of crude, notably from the Middle East and the Atlantic Basin. The corresponding physical markets have seen prices rise. In our view, the buying spree is a knee-jerk reaction to the uncertainty around future Russian exports. It is always preferable in these circumstances to be overhedged rather than not hedged enough. But let us begin this podcast with positioning on Brent futures. Vincent, in last week's podcast, we commented on how many managers had rebuilt their net long positioning to levels last seen in July last year in the ICE Brent futures. In this week's commitment of the futures data that went to Tuesday of last week, has this trend continued?
Yes, Mita. So it's been exceptionally bullish week. The latest ICE COT data showed that money managers in the week to the 7th of Jan, they got longer, with net positioning increasing by 20% for the second week in a row. So just underscores the bullish trend that's been going on since November, where funds have been getting longer in 7 out of these 8 weeks. So with the prospect of tougher sanctions on Iran and Russia as a bullish catalyst, traders certainly feel confident to add length at the start of the year and to get rid of their previous short positions. This is also in the context of continued OPEC cuts and optimism for demand out of the US and China.
That makes sense. And I take it that the long-short ratio must have increased as well in line with this.
Yes, so the long-short ratio increased to 3.7 to 1 from the money manager perspective, so the highest level since early May. So it is getting in line with what we had around these levels last year during May when Brent was above 80. And also this positioning, the most recent data happened before the sanctions headline, which came out on the 10th of Jan on the Friday, which firmly pushed that price above 80. So the least recent data shows that the positioning from a percentile basis is still from the 44th percentile for all weeks since 2013, so still below the medium. Still, you could say it's technically still slightly more bearish, so there's still plenty of room for more bulls to enter.
That makes sense. As you mentioned that this was dated, it was before the sanctions were announced, but we do have more timely data. Onyx's CTA model, for example. So did the CTA positioning, did that indicate whether risk takers have further increased their length on Brent futures since the sanctions were announced, for example?
Yeah, certainly by a substantial amount, so likely helped by buy signals from technical indicators such as short-term moving averages crossing above the longer-term ones. Positioning by CDA since the sanctions announcement saw them purchase 24 million barrels in Brent, according to our estimates. So overall, that net positioning is the most bullish since mid-April, and it seems like that bullish positions are approaching a peak. So just from a CDA perspective, we can see that the momentum, the bullish momentum might be waning here.
So we've addressed the bullishness and just the changes in positioning. Let's get into what's happening, and let's get right to the sanctions itself. Marta, could you review what is at stake with the latest slew of sanctions?
Yeah, of course. So as you mentioned in the introduction, there are the new sanctions on the two major oil companies, which are the Gazprom Neft and Neft Gas, apologies. So that came under sanction, which equate to about 900,000 barrels a day of crude. And looking at the grades involved, it's mostly ESPO. So that's the grade that the smaller Chinese independent refineries are after most of the time. It's cheap and they're kind of happy to run this grade of crude, which is not so desirable elsewhere. However, China's willingness to kind of ride with these sanctions is brought into question as they haven't really with the others. So it would be interesting to see how much they are abiding by the sanctions with tariffs involved as well, which could make them even less attractive to abide by.
Of course, just with the tariffs and all coming as well. So just in the near term, what do you think could happen to Russian exports? Do you think exports will decline immediately?
I think the thing to be looking at, the thing that the market is looking at right now isn't the actual oil companies themselves, but the sanctioned dark fleet vessels. So we've seen the dark fleet vessels, mostly crude carriers, Aframax or LR2 types, and these would carry about 350 million barrels of crude oil a year, as we've mentioned previously, mostly to China and also to India. So that's about 1.4 million barrels a day of crude oil, which is about 40% of Russia's seaborne crude oil here. So this is what the market is really focusing on, is the prices of these dark fleet vessels, its freight rates, and the sanctioned vessels equivalent being taken to China and India is really where the focus is. But looking at exports, I know that was your original question, like, will we see them decline immediately? I don't think that knee-jerk reaction, as you said, maybe the reaction from the market has been quite knee-jerky. I don't think that will happen in the physical because India, who is one of the big undertakers of this, said that they're giving themselves a wind-down period till about mid-March, March the 12th. So I think that kind of prevents any more of a knee-jerk reaction in the physical exports. But when they're no longer permitted to offload the sanctioned vessels, the question becomes whether Russia has alternatives to keep the oil flowing. So after this period and when the sanctioned vessels are no longer permitted to export the crude, the question becomes whether Russia has any alternatives to keep the oil flowing. There is always the option that these sanctioned vessels can become like legitimate ships, but this would push freight rates higher. We've seen freight rates really, really react to this news. So Russia could simply discount its crude to offset the cost of the crude delivered to port, but again, that would be impacting the revenue sheet of Russia, which is the aim of these sanctions in the first place. But we don't really have any visibility on what they would do, what Trump is going to do into the future, which I think is just a running theme of not really knowing what he's going to do, but especially looking to Russia and Ukraine. So whilst he's been in office, Biden's kind of wielded the big stick, but Trump might prefer to use more of a carrot method and kind of incentivize Russia to make the decision themselves to get oil flowing again. But we'll just have to wait and see. I think when we're looking at the global balance that we have at Onyx, if Russia is not able to find, for argument's sake, a workaround, then a loss of about 1.4 million barrels a day, as I mentioned before, of crude exports and a corresponding shutdown of its production will undoubtedly average to about 1.2 million barrels a day surplus that we didn't have in our balance previously. That also assumes that OPEC plus countries do not step up their production to take advantage of the gap. So if history is a guide, we can look at what happened when the first sanctions were introduced on Russia. Following the invasion in 2022, the ensuing drop in production proved ultimately short-lived, and they were actively looking for workarounds, which I'm sure that they have contingency plans a million times. So it's definitely something to be watching, the routes of workarounds, because there are always workarounds. But yeah, there is still uncertainty about the Russian crude exports, and the uncertainty is very much pricing against the physical markets right now. I think that's clear.
I like how you worded that, just that we don't have that much visibility on, because there's so many moving parts right now. Russia could still have options with how it's going, whether declining its, as you mentioned, the price of its crude to offset potentially higher freight, potentially finding new dark fleet vessels. India has given itself some buffer space to speak until March. So there definitely is time to see how all of this is going to unfold. But because you mentioned pricing and how uncertain that is, let's move to pricing. That's a great turning point. With the uncertainty around Russian crude, I expect Chinese and Indian buyers must be rushing to find alternative sources of crude. So how is that translated into differentials, such as the Brent-Dubai spread, for example?
So yeah, certainly the Brent-Dubai spread has been a core focus these days. Especially with Russian barrels needing to be replaced. The Urals are more skewed towards medium sour, and where could you find much of that crude? That's the Middle East, and this is also happening in the context of continued OPEC cuts. So Brent-Dubai, the price movement has been very abrupt. The front-month swap spread is showing that Brent is in deep discount to Dubai. Last time we checked it, it was minus $1 per barrel, which is near all-time lows, last reached in August 2023. And the Baljan has fallen below minus 2, which shows just how strong, how tight the Dubai market has been. And the Onyx officials estimate the Dubai physical premium at $470 per barrel, which is up by $3 in just 1 week. So that is monumental. The pricing difference between the two crudes is accompanied by a difference in price structure too. So Dubai backwardation in the first 2 months are much steeper than that of Brent. So our proprietary COT data is showing one-way flow here, buying in Dubai spreads and selling in Brent Dubai outright, as well as the boxes. So these have come from all types of players, both financial and physical. Banks, hedge funds, trade houses, majors, you name it, one direction flow. And the fact that open interest in the February 25 tenors in both Brent Dubai and Dubai swaps has fallen by 10% in the past week shows that there has been a lot of position closures, stop outs in this move, which has reinforced the direction of prices. So all of this goes to show the tight market, and there is certainly a lot of panic buying here. From refiners, the market was already on its way up with cold weather disruptions, low US crude, especially cushioning inventories. Data Brent was already on an upwards trend. So the recent news added fuel to the fire on top of OPEC cuts, and this is naturally bullish for Dubai crude. So surge in premiums encapsulates the magnitude of this disruption. And as Martha mentioned, the sanctions vessels amount to 1.4 million barrels per day, which is no small number. So the question is, like, how low can Brent Dubai go?
How low can Brent Dubai go? I think panic is the word there with what's happening in the market. Martha, you indicated that the volume of product vessels affected by the sanctions was relatively modest compared to crude. But have you seen any noticeable movement in at least the east-west spreads for naphtha or for diesel? Has there been any noticeable competition that's been seen due to these sanctions for diesel?
So we've seen some upwards movements in the gas oil futures, and I think you can attribute a part of this, for sure, to the new sanctions, because gas oil is such an important part of the barrel for Russian crude. But there are other factors at play, like the weather in the US, the storms on the way to the south, which I think we'll talk about more on the officials podcast. But so I won't start talking about weather forecasts. But it's really difficult to see. The naphtha, which is another important product for Russia, has seen little to no change. You'd have to look at the impact on the sanctions onto the companies, specifically for the products, I think, of Gazprom Neft and Saturnovsgaz. Exports of diesel are the more likely product to see significant adverse effects, with the loss of diesel estimated to be about 150,000 barrels a day, which would, as you were saying, lead for greater competition for non-Russian diesel. I think especially there's lots of kind of fear-mongering online about the weather and stocks and electricity. So I think that's definitely the product to keep an eye on here. So the East-West, there's been a broad movement post the sanctions. So you could argue that Europe is going to have to compete harder for its gas oil supplies from Asia.
Well, that brings us to our crystal ball movement. Earlier this week, we predicted oil prices would close the week between $79 and $82 a barrel. Currently, we're trading above $81. Is this the new normal for Brent after being in around the mid-70s for most of last year? The market is bullish on the news of the sanctions, eyeing fewer supplies to the market out of Russia. But should supply from Russia indeed drastically fall, this could be replaced by the voluntarily cut barrels out of OPEC, and OPEC could go beyond that as well, seeing this as an opportune movement to do so. Certainly, countries like the UAE can produce more and could take advantage of the incremental demand for crude out of India and China. So looking ahead, the question for today is, do you guys think we will be around $80 a barrel at the end of Q1?
I think we'll be sub 80 by the end of Q1, or would have been sub 80 and then maybe corrected again. I think what you're saying about bringing the physical barrels back, a great excuse to bring them back would be any kind of rulings from Trump about tariffs on Canadian energy. I think that's what I'm looking at almost exclusively, is the market is rebalancing now from all the shorts like me who've been very stubborn and added more and more short positions. The market is finally readjusting and we're getting this kind of stability around these 80 levels. I think that there's still a while to go. As Vincent said, in the COT data, we're still fairly bearish in the money managers. But I think once it's balanced, there may be room to go down if there is a cancellation or a reduction in the proposed oil and gas tariffs on Canada. I think that would be a great excuse if it goes either way. I think if it does happen, that would obviously pressure prices higher, of course, but then it would be a good point for better supplies to be brought into the market from OPEC, who I think would save face and use anything to kind of be that good guy in the market. But I think there's definitely room to go down from here. Looking at the spreads, they're really, really high. Margins are growing weaker, especially in Asia. So keep an eye on run cuts there. Obviously, everyone has their own estimations of the refinery rate, but it's falling low.
Vincent?
Yeah, so I am confident about Brent holding an $80 floor. Recently, it bounced a pull at $80. The rally didn't fade as it had been over the past few months. So with the expected removal of barrels from the market, time spreads have been surging, leading to price volatility spikes. But from a supply side perspective, I do think that the $80 is justified. So margins are on a downtrend, however, not as much as we thought despite the flat price rise, which is a cautiously optimistic sign. And of course, we've seen some hedging flows in the product cracks as well. So whether or not we build on from the $80 levels, that will depend on Chinese demand recovery and whether these stimulus measures are effective enough to generate more oil consumption. January has often been a bullish time for the market, with traders starting the year with fresh P&Ls, but they will need to see more of that demand side recovery to justify holding on to these positions and to add more. I would be looking at what Trump would be doing in terms of his foreign policy with respect to the Middle East as well as Russia-Ukraine. That will be a big thing for the oil market. And also whether or not if flat price levels are sustained, perhaps this will lead to OPEC bring back barrels to the market, and that will have a huge change for in terms of like price action and sentiment.
I like how we've got our usual perennial bull and a perennial bear, like you guys have. Yeah. Personally, I find it hard to think that we'd be significantly above 80 or just comfortably above 80 at the end of Q1. We might go in and out, perhaps. I do think if, say, we have the 1.4 million barrels completely wiped out, I think that would be an opportune moment for OPEC to come in with their wallet, bringing back their barrels that they've taken out of the market. In terms of, on the other hand, though, financially, as Vincent has said, we are under the median when it comes to net positioning on a percentile level. I think that is interesting. That just indicates that there is further room for bullishness if, let's say, there is an issue with supply, there is room for us to go above 80, which is quite exciting. Technically, however, we are in overbought territory, which I think is significant. We've been seeing volatility has been high, and as Vincent said, Donald Trump's inauguration next week, and what that means for the conflicts in between Russia and Ukraine, and even the conflict in Gaza, and just with everything happening around the Red Sea, all of that's going to be really key to watch. It'll be key to watch what Trump's going to do about all of that. Trump is also, in all likelihood, going to place maximum pressure on Iran, which could be another interesting development vis-a-vis oil. Again, bringing this to technical indicators, the 10-day moving average is providing useful support to the market at present, and this is just under $80. It's around 78 to 79, which again is quite interesting. The fact that the support is right below 80, so we are currently in this $80 state. But yeah, I just think it is an opportune time for OPEC to bring back their barrels. So that would be an interesting development to see. With that, we conclude this podcast. Thank you, everyone, for joining in today. Until our next episode, and in Harry's words, please do not forget to smash that like button and subscribe to our podcast. Thank you.